The WADDAH ATTAR explosion applies a 15-period trend power and explosion moving average for determining the volume moving average. The changes in the volume bar's color help you identify whether bulls or bears control the market. And the moving average line shows the overflow or deficiency of the asset's supply and demand. The blue volume bar indicates the accumulation, and the red bars signal the distribution of the asset. Go for long opportunities like bullish breakouts or price reversals when the demand or blue bar rises above the volume moving average. The bars fall below the average after turning red when the demand declines to signal a buy exit. The red volume bar needs to spike above the average line for shorts, confirming a supply overflow. After activating a sell order, hold it until the bars fall below the average line. WADDAH ATTAR explosion indicator by conditions. First, the volume bars turn blue and move above the average line. Second, the price attempts a bullish breakout or a reversal at a significant support. Third, exit long when the volume bar turns red. WADDAH ATTAR explosion indicator sell conditions. First, the volume bars switch to red color and turns above the average line. Second, the price plots a bearish breakout or a bearish reversal pattern at the exact period. Third, exit short after the volume bars start showing up in blue color. And now, how to identify the strongest and most profitable trends to trade. WADDAH ATTAR explosion trading strategy. In this video I will show you how to identify the strongest and most profitable trends to trade. As always, this video provides a clear, winning, step-by-step guide to how to successfully trade in the forex, stocks, commodities, or any financial markets and generate consistent profits. So, by the time you finish this video, you'll know exactly when to enter high probability trade using the WADDAH ATTAR explosion indicator. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. The WADDAH ATTAR explosion indicator is an advanced volume indicator that visualizes the balance between positive and negative trading volumes for predicting upcoming market trends. This indicator is an excellent match for forex, stock, crypto, and commodity traders who consider trading volume the key market mover. Clear demonstration of market accumulation or distribution and simple rules of determining trade signals are the main reasons behind the vast popularity of the WADDAH ATTAR explosion. Trading volume. As we're sure you've heard before, without volume, markets don't have the fuel they need and tend to whip back and forth without direction. Sadly, many traders ignore market volume simply because they do not understand it. Trading volume can help an investor identify momentum of a stock or currency pair and confirm a trend. If trading volume increases, prices generally move in the same direction and can provide a heads up if volume diminishes. Once volume begins to diminish and the fuel for the trend starts to dry up, a reversal or ranging market may be on the horizon. Here is an example of what the indicator looks like. There are three components to this indicator: blue histograms, red histograms, and a black explosion line. The red histogram indicates the current downtrend. The blue histogram indicates the current uptrend. The black line's direction shows the explosion price up or down. The WADDAH ATTAR explosion applies a 15-period trend power and explosion moving average for determining the volume moving average. The changes in the volume bar's color help you identify whether bulls or bears control the market. And the moving average line shows the overflow or deficiency of the asset's supply and demand. The blue volume bar indicates the accumulation, and the red bars signal the distribution of the asset. Go for long opportunities like bullish breakouts or price reversals when the demand or blue bar rises above the volume moving average. The bars fall below the average after turning red when the demand declines to signal a buy exit. The red volume bar needs to spike above the average line for shorts, confirming a supply overflow. After activating a sell order, hold it until the bars fall below the average line. WADDAH ATTAR explosion indicator by conditions. First, the volume bars turn blue and move above the average line. Second, the price attempts a bullish breakout or a reversal at a significant support. Third, exit long when the volume bar turns red. WADDAH ATTAR explosion indicator sell conditions. First, the volume bars switch to red color and turns above the average line. Second, the price plots a bearish breakout or a bearish reversal pattern at the exact period. Third, exit short after the volume bars start showing up in blue color. And now, how to identify the strongest and most profitable trends to trade. Trend trading is a strategy that involves traders waiting till a defined trend has been established in a stock, forex, crypto, or commodity before taking a position. This can be done by buying asset if the market is trending higher, or selling asset short if the market is trending lower. Trend trading can also be done on different time frames, so whether you are scalping, day trading, or swing trading, trend trading can help you stack the odds in your favor. Identifying the most profitable trends to trade. If we want to successfully identify the strongest and most profitable trends to trade, the first step is being able to identify if a market is trending or range-bound. The most profitable pullback pattern doesn't apply in range-bound scenarios, as there is no real trend in price direction, so there's no reason to expect that the market will bounce back following the pullback. Trend identification, despite the several philosophies and indicators revolving around it, is quite simple. A trend is simply a series of higher highs and higher lows, vice versa on the short side. Let's take a look at a trend on the long side. As you can see, each consecutive high is above the previous high, and each low is above each previous low. Until this cycle breaks, this market is considered to be in an uptrend. These are the fundamentals of trend identification. How to use moving averages to find the trend. One sweet way to use moving averages is to help you determine the trend. The simplest way is to just plot a single moving average on the chart. When price action tends to stay above the moving average, it signals that price is in a general uptrend. If price action tends to stay below the moving average, then it indicates that it is in a downtrend. The problem with this is that it's too simplistic. Let's say that British pounds United States dollar has been in a downtrend, but a news report comes out causing it to surge higher. You see that the price is now above the moving average. You think to yourself, it looks like this pair is about to shift direction. So, it's the perfect time to buy the British pounds United States dollar. So you do just that. You buy 1 billion units cause you're confident that British pounds United States dollar is going to go up. And, bam! You get faked out. As it turns out, traders just reacted to the news, but the trend continued, and the price kept heading lower. What some traders do, and what we suggest you do as well, is that they plot a couple of moving averages on their charts instead of just one. This gives them a clearer signal of whether the pair is trending up or down, depending on the order of the moving averages. Let us explain. In an uptrend, the faster moving average should be above the slower moving average, and for a downtrend, vice versa. For example, let's say we have two moving averages. The 20-period EMA and the 50-period EMA. Throughout the uptrend, the 20-period EMA is above the 50-period EMA. As you can see, you can use moving averages to help show whether a pair is trending up or down. By combining this with your knowledge of trend lines, this can help you decide whether to go long or short a stock or a currency pair. You can also try putting more than two moving averages on your chart. Just as long as lines are in order, faster moving average over slower moving average in an uptrend. and slower moving average over faster moving average in a downtrend. The CCI indicator is a great tool to confirm trends. You can make large amounts of money by following trends without putting in a lot of effort. Often, trend-following strategies can be successful for years at a time. You will face a problem if you use only 20-period EMA and 50-period EMA indicators, since at some point the trend will turn into a period of consolidation, and trend-following strategies will fail. When you combine the CCI with a trend indicator like a moving average, market volumes, plus your knowledge of price action, you can identify the strongest and most profitable trends to trade. And now, what is the Commodity Channel Index Indicator, or CCI indicator? The Commodity Channel Index, or CCI, is a momentum-based oscillator used to help determine when an investment vehicle is trending and reaching a condition of being overbought or oversold. The CCI indicator was created by Donald Lambert and was initially used to identify cycles in the commodity market. However, it tends to perform the same in the stock market or the forex currency market, and even the cryptocurrency market for that matter. As you may guess by now, the only indicator you need to spot new market cycles is the CCI indicator. So, what does the Commodity Channel Index tell you? The CCI indicator is primarily used for spotting new trends, watching for overbought and oversold levels, and spotting weakness in trends when the indicator diverges with price. When the CCI moves from negative or near zero territory to above 100, that may indicate the price is starting a new uptrend. Once this occurs, traders can watch for a pullback in price, followed by a rally in both price and the CCI to signal a buying opportunity. The same concept applies to an emerging downtrend. When the indicator goes from positive or near zero readings to below -100, then a downtrend may be starting. This is a signal to get out of longs or to start watching for shorting opportunities. Overbought or oversold levels are not fixed since the indicator is unbound. Therefore, traders look at past readings on the indicator to get a sense of where the price reversed. For one stock, it may tend to reverse near +200 and -150. Another commodity, meanwhile, may tend to reverse near +325 and -350. Zoom out on the chart to see lots of price reversal points and the CCI readings at those times. There are also divergences when the price is moving in the opposite direction of the indicator. If the price is rising and the CCI is falling, this can indicate a weakness in the trend. While divergence is a poor trade signal, since it can last a long time and doesn't always result in a price reversal, it can be good for at least warning the trader that there is the possibility of a reversal. This way, they can tighten stop-loss levels or hold off on taking new trades in the price trend direction. How the professional traders use the CCI indicator strategy. The zero line in the CCI indicator is the line in the sand between the bulls and the bears. This means that we can use the crossing of the zero line to gauge a shift in the market sentiment. So, here is how to trade using CCI indicator. When the CCI oscillator crosses from below the zero line, that's signaling a shift from bearish momentum to bullish momentum. In other words, the dominant market energy is to the upside. Conversely, when the CCI oscillator crosses from above the zero line, that's signaling a shift from bullish momentum to bearish momentum. In other words, the dominant market energy is to the downside. Now, we don't recommend completely relying on these signals alone. You need to use them in combination with your price action reading skills. WADDAH ATTAR Explosion Trading Strategy. The following step-by-step tutorial of the WADDAH ATTAR Explosion Trading Strategy will use the British Pounds United States Dollar Forex market, but exactly the same steps should be used on stock trading, commodity, crypto, and whichever markets you are trading with this trade, because price action stays relatively consistent across different assets. Step number 1. Add 25-period CCI, WADDAH ATTAR Explosion, 20-period EMA, and 50-period EMA. Step number 2. Watch the market. Watch the market and wait until the market is active and moving decisively. Wait until the 20-period EMA is above or below the 50-period EMA. While the 20-period EMA is above or below the 50-period EMA, the 25-bar CCI is on the correct side of the zero line. This means that if the 20-period EMA is above the 50-period EMA, the 25-period CCI should also be above the zero line, and the WADDAH ATTAR explosion volume bars turn blue and move above the average line. And vice versa, if the 20-period EMA is below the 50-period EMA, the 25-period CCI should also be below the zero line, and the WADDAH ATTAR explosion volume bars turn red and move above the average line. So, if the trade has not met its requirements and should not be entered. There is no default order type for the WADDAH ATTAR explosion trade entry, but for the recommendation is a limit order. As soon as your entry order has been filled, make sure that your trading software has placed your stop-loss orders, or place them manually if necessary. Bullish trade scenario. When seeking to open buy positions, observe indicator readings as follows. First, the 20-period EMA is above the 50-period EMA. Second, the 25-bar CCI should also be above the zero line. Third, the WADDAH ATTAR explosion volume bars turn blue and move above the average line. Entry. When these conditions match your target asset chart, it positively influences the asset price. So, open a buy position when the high of the entry bar is broken by a subsequent bar. Set an initial stop loss below the current swing low with a buffer of 5 or 10 pips. Bearish trade scenario. When seeking to open sell positions, observe indicator readings as follows. First, the 20-period EMA is below the 50-period EMA. Second, the 25-bar CCI should also be below the zero line. Third, the WADDAH ATTAR explosion volume bars turn red and move above the average line. Entry. When these conditions match your target asset chart, it negatively influences the asset price. So, open a sell position when the low of the entry bar is broken by a subsequent bar. Set an initial stop loss above the current swing high with a buffer of 5 or 10 pips. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Here are other examples of the WADDAH ATTAR explosion trading, to fully understand this wonderful strategy, and to make the most out of it. WADDAH ATTAR Explosion Indicator is probably one of the best and most popular custom indicators to identify the strongest and most profitable trends to trade. The indicator is ideal for trend-following strategies to spot a continuing trend. Also, the WADDAH ATTAR Explosion Indicator can be an entry or exit signal. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell and leave us a like to show your support. See you next time.